A weekly payment can feel like proof that an income fund is working. But a payment is only one exit door for your money. The other door is the value of the shares you still own. If cash keeps coming out while that share value keeps shrinking, the fund may be serving dessert by carving up the dining table. Today's autopsy is a particularly intense case. A single stock income machine with leverage, derivatives, and a headline payout built to stop thumbs in mid-scroll. The question is not whether the cash is real. It is. The question is what economic engine produced it, what risks rode along, and what remained after every moving part had its turn. Today, Income Autopsy is dissecting the Granite Shares Yield Boost AMD ETF, ticker AMYY, issued by Granite Shares, using data as of July 15, 2026. The fund launched on September 16, 2025. It is an actively managed equity fund in the derivative income category, tied to the daily price performance of Advanced Micro Devices, Inc. This is not a plain stock position wearing a dividend hat. It is trying to pursue current income, deliver amplified daily exposure to one volatile semiconductor company, and use options to turn market movement into cash. Those goals can cooperate, but they can also fight. A large distribution may reward the shareholder, return some of the shareholder's own capital, or combine both. So we are not grading this fund by the size of one payment. We are tracing the whole circuit: the operating scale, the quoted yields, the payment trend, the path of net asset value, the distribution inclusive result, and the machinery under the hood. By the end, a first-time viewer should be able to look at this kind of product and ask a better question than, how much does it pay? This video is for research and education only. It is not financial, investment, tax, or legal advice, and it is not a recommendation to buy, sell, or hold any security. ETFs can lose value, including funds designed to produce income, funds using derivatives, and funds seeking leveraged exposure. Distribution rates, holdings, market prices, tax character, and strategy details can change. Verify the current prospectus, shareholder reports, distribution notices, holdings, and other official fund documents before making any decision, and consult a qualified financial, tax, or legal professional for advice specific to your circumstances. Start with the operating profile. This fund pays weekly. That cadence can feel dependable even when the amount varies, so the schedule itself should never be confused with stability. The expense ratio is 1%. That fee is part of the drag the strategy must overcome before the shareholder can judge the end result. Assets under management are $9 million. That is a small pool, so researchers should watch whether trading remains orderly, whether bid and ask spreads are reasonable, and whether the issuer can operate the product efficiently. Small size does not make a fund bad, but it adds practical due diligence. The most useful snapshot conclusion is that this is a young, compact, high-complexity vehicle with frequent cash flow. None of those traits supplies a verdict by itself. Together, they tell us not to treat the product like a mature utility stock whose business model can be understood from a dividend calendar. Now to the billboard number. The headline distribution yield is 98%. That figure describes a payout rate under the fund's stated calculation convention. It does not promise the same cash stream for the next year, and it does not measure what the investment retained after changes in share value. A second lens, mechanically annualizing the latest payment, gives 77%. Think of that as taking one recent weekly check, copying it across a calendar, and asking what the resulting pace would look like. The arithmetic may be useful, but the assumption is heroic. Markets do not photocopy themselves. Option premiums change, volatility changes, the share base changes, and managers can alter what gets distributed. Why can either figure become so large? Because this is not ordinary corporate profit passed through as a conventional dividend. The cash can include derivative premium and return of capital. Return of capital is not automatically sinister, but it is not free money. If a fund sends part of the investment back while the asset base falls, the payout meter can look spectacular even as the remaining machine gets smaller. That is why yield is the beginning of the investigation, not the conclusion. For a product like this, compare the distribution rate with the direction of the underlying share value, the payment history, and the complete return. The loudest number on the page is often the least complete sentence. The distribution record tells a clear story of deceleration. The latest payment was 23 cents per share. The first four average was 46 cents, while the latest four average was 24 cents. In plain English, the early checks set a pace that the recent checks have not maintained. The trend is down from the launch period payouts to the latest four paid rows. That does not prove the next payment must fall. Weekly distributions can bounce because the ingredients feeding them are variable. But it does tell us that projecting the launch experience indefinitely would have been a mistake. Early payouts are a tiny sample taken during one market regime, not a contractual salary. For an income product, predictability can matter as much as magnitude. A huge but unstable stream may be less useful for recurring expenses than a smaller stream with a durable source. From here, the important observation is not simply that payments changed. It is that the distribution schedule responds to the opportunity set and the fund's economics. If volatility cools, if option pricing becomes less generous, or if the portfolio's capital base changes, future cash may look different again. The history is already warning us not to turn a variable strategy into a fixed income fantasy. Now follow the part of the investment that stays behind after the cash leaves. The launch reference price was $24.77. The latest NAV was $15.35. Since inception, the NAV return was negative 38% and the maximum drawdown was negative 42%. This is the capital path evidence. A drawdown measures the fall from a prior peak to a later low, so it captures the experience of being underwater, not merely the difference between the first and last observation. That distinction matters because investors live through paths. A portfolio can finish at a tolerable endpoint after forcing its owner through a decline severe enough to trigger panic, a margin problem elsewhere, or a badly timed sale. The NAV decline also changes how we interpret the income. Distributions reduce fund assets when paid. Derivative losses, leverage effects, expenses, and market movement can also affect the share value. Without the fund's complete accounting, we should not assign every lost dollar to one cause. We can say something narrower and more useful. The residual value fell substantially during the measured period, so the checks did not arrive alongside capital stability. Someone who spends every payment may see real money reach the bank while the account balance looks wounded. Reinvestment changes the share count, but it does not erase the strategy's risk. The autopsy has to keep both the cash and the remaining shares on the same table. This is where the story becomes more balanced. Cash distributions since launch totaled $14.99 per share. Using the provided simple distribution inclusive calculation, the return since inception was 22%. That result explains why the price chart alone is incomplete. Cash left the fund and reached the owner. Add it back and the economic picture changes. Price return asks what happened to the wrapper. Distribution inclusive return also counts the money it released. But a simple deserves respect. This measure is not every investor's realized experience. Purchase date, sale date, reinvestment, taxes, and trading spreads can all change the outcome. There is also a sustainability question. A positive result over this window tells us what happened. It does not guarantee that the same combination will continue. If future distributions remain high enough to offset further capital loss, the complete return can stay resilient. If payments weaken while the residual value keeps deteriorating, the arithmetic can turn quickly. Total return is there for the scoreboard, not a prophecy. It gives the fairest historical verdict available from the supplied figures while leaving tomorrow undecided. Here is the machine under the hood. The reported portfolio shows us dollars at 50%, United States Treasury bills at 33%, and cash equivalents at 20%. Plus 6 put options. The fund writes for premium income. There is no external index listed. The economic target is a single stock, and the mandate seeks daily 2 times leverage to its price performance. That composition can look strange if you expect a conventional equity fund stuffed with common shares. But derivatives can create market exposure without the portfolio holding an equivalent pile of stock. The cash-like assets and short government bills can serve as liquid collateral and a reserve around the contracts. The puts are where part of the income story becomes visible. When the fund writes a put, it sells someone else downside protection and receives premium up front. The buyer gets a contractual right tied to a specified strike and expiration. The seller accepts the obligation on the other side. We are not given those contract details here, so we should not invent them. The general payoff is enough to understand the bargain. If the reference shares stay above the relevant strike through expiration, the option can expire without an intrinsic payout and the seller keeps the premium. If the shares plunge below that strike, the put can lose value rapidly for the seller because the protection it sold becomes valuable to the buyer. Picture a sudden weekly plunge in the chip maker. The cash reserve does not make that event harmless. Written puts can move against the fund, and the leveraged daily objective can amplify the portfolio's reaction. Premium collected earlier acts like a cushion, but a cushion is not a concrete wall. In a sharp sell-off, the loss on the risk accepted can exceed the income collected for accepting it. Now add the daily reset. What should researchers watch from here? First, track a rolling window of weekly payments rather than celebrating or panicking over one row. The direction and variability of the stream will tell you more than a single annualized quote. Second, put cumulative cash and the NAV path on the same chart. If payments remain large while the capital base stabilizes, that is a different case from large payments accompanied by persistent erosion. Third, read the newest holdings and options schedule. Count the open contracts, note their expirations and strikes, and compare the obligations with the liquid collateral. Those details show how much downside insurance the portfolio has sold and when that risk can become acute. Fourth, watch the volatility regime around the underlying company. Richer option pricing may create more income opportunity, but it usually exists because the market perceives more uncertainty. Premium is hazard pay, not a coupon from the universe. Fifth, monitor trading quality as the fund grows or shrinks, assets, spreads, volume, and the gap between market price and NAV. A sound thesis can still be damaged by poor execution in a small vehicle. Sixth, inspect distribution notices and year-end tax documents instead of guessing what the cash represents. Option income, gains, and return of capital can have different implications, and labels may be revised as accounting is finalized. Finally, compare this product with the simplest alternative that matches your actual goal. If the goal is long-term participation in the company, a direct position offers a cleaner exposure. If the goal is spendable cash, ask whether the variability and capital path fit the bills the income is supposed to cover. Complexity should earn its place. The verdict is not big yield bad, and it is not cash distributions rescue everything. So far, meaningful cash reached shareholders, the remaining share value took serious damage, and the combined historical calculation ended in positive territory. That makes the product neither a magic paycheck nor a simple disaster. It is a high-intensity tool whose success depends on the whole package: the path of the linked stock, the behavior of daily leverage, the price of downside insurance, the manager's contracts, the distribution policy, and the investor's timing and use of the cash. For everyday investors, the key question is fit. Can you tolerate a rough capital path? Can your income plan absorb changing weekly payments? Will you read derivative disclosures instead of buying the headline? And are you judging wealth by total economic value rather than by the size of the latest deposit? Income Autopsy's final diagnosis: treat the payout as evidence to investigate, not income to worship. The check matters. The shrinking or growing asset behind it matters too. Only when both stay in frame can you tell whether the machine is creating value, transferring risk, returning capital, or doing all three at once. Two quick things before you go. If this teardown helped you see past the headline yield, hit the like button. It genuinely helps the channel. Subscribe so the next ETF autopsy lands in your feed. And drop a comment. Which ticker should we put on the table next, and where do you think the real risk is hiding? We read everyone. Thanks for watching.